You checked your credit score last month. It was 724. Not perfect, but solid. You felt good about it. You have been making every payment on time, every single month, for over 2 years now. No late fees, no missed bills. You have been doing everything they told you to do. So you log in again this month. Maybe you are thinking about buying a car, or finally applying for that apartment with the better neighborhood. You type in your password, the page loads, and the number stares back at you. 697. 27 points gone. No explanation. No email. No warning. Just a lower number on a screen. And now you're sitting there trying to figure out what you did wrong. But here is the thing that is going to mess with your head a little. You did not do anything wrong. You just did not understand how the system actually works. And that right there is the trap that catches millions of people every single year. They follow all the surface level rules, pay on time, do not spend too much, be responsible, and they still get punished because there is a whole layer of mechanics happening underneath the score that nobody bothers to explain. Here is what I am going to do in this video. I am going to pull back the curtain on that system. I am going to show you the actual hidden factors that move your credit score even when your behavior has not changed at all. And then I am going to give you a set of specific moves you can make this week, not someday, this week, that will start pushing that number back in the right direction. But here is the part most people skip right past and regret later. The fix is not just about fixing the number. It is about understanding the machine so it can never surprise you like this again. Stay with me, because once you understand how this actually works, you will never look at your credit score the same way. Before we get into the hidden causes, I want you to think about credit scoring systems the way I do. Think of it like a photograph. Your credit score is not a live video feed of your financial life. It is a snapshot. A single frozen image taken at a very specific moment in time. And that image is used to judge everything about how you handle money. Now here is where it gets interesting. The photo can change based on lighting, based on timing, based on things that have nothing to do with your actual behavior. You could be the most financially responsible person on earth. When and if the photo is taken at the wrong moment, right after you used your card heavily before paying it off, right after a lender pulled your credit, right after your oldest account closed, the photo looks bad and the score drops. The score does not know your intentions. It only knows what the data looks like in that moment. That is why people who do everything right still get surprised. They are not managing the photograph. They are just hoping it comes out well. So let us talk about what actually controls how that photo looks. Because most people believe the same wrong thing. Most people believe that a credit score is basically a report card on how responsible you are with money. Pay your bills on time. Do not go crazy with spending. Keep your nose clean. Score goes up. That belief is not completely wrong, but it is dangerously incomplete. Because what actually determines your score is a 5-factor formula. And only one of those 5 factors is about whether you pay on time. Just one. And yet that is the only one anybody ever talks about. The other 4 factors, the ones that nobody explains to you, those are the ones that move silently in the background. The ones that can drop your score without any change in your behavior at all. Let me walk you through all 5, and pay close attention to the ones that come after the first, because those are where the real damage usually happens. The first factor, the one everyone knows, is payment history. This accounts for 35% of your score. Do you pay on time? Have you ever been late? Any collections, bankruptcies, repossessions? This is the most important single factor. And for most responsible people, it is also the strongest part of their score. Great. You have that covered. The second factor. This is where people start getting confused. It is called credit utilization, and it accounts for 30% of your score. 30%. Almost as much as payment history. And this is the one that catches most people off guard. Credit utilization is simply the ratio of how much credit you are currently using versus how much you have available. If you have a credit card with a $5,000 limit and your balance right now is $2,000, your utilization on that card is 40%. Now here is the part no one tells you. Your credit card company reports your balance to the credit bureaus once a month. And they report whatever your balance is on the statement closing date, not the date you pay. So even if you pay your card in full every single month, which is exactly what you are supposed to do, if your balance is high on the day the statement closes, you get reported as a high utilizer, and high utilization tanks your score. Fast. This is why someone who is completely responsible, someone who never carries a balance, can still see their score drop significantly just because they used their card heavily before the statement closed. The system saw the balance. It did not see the fact that you were about to pay it off in 3 days. Here is where people mess up constantly. They think utilization is measured by how much they spend in a month. It is not. It is measured by what the snapshot looks like on one specific date. One day determines 30% of your score. That is a big deal. The third factor is length of credit history. 15% of your score. The longer your accounts have been open, the better. The scoring model loves stability. It loves to see that you have managed credit relationships over a long period of time. Here is an edge case that trips people up. If you close an old credit card, maybe you got a new one with better rewards, and you figure you do not need the old one anymore, you could be cutting the average age of your credit history. And if that old card was your oldest account, the hit can be significant. The account you thought was just gathering dust was actually doing work for you every single month just by existing. The fourth factor is credit mix. 10% of your score. Now this one is about whether you have different types of credit. Credit cards, an auto loan, a mortgage, a student loan. Having a mix of revolving credit and installment loans shows the scoring system that you can handle different financial responsibilities. Most people do not need to overthink this one, but it is worth knowing it exists. The fifth factor, and this is a sneaky one, is new credit. 10%. Every time a lender does what is called a hard inquiry on your credit, meaning they actually pull your full credit report to make a lending decision, your score takes a small hit, usually between 2 and 5 points. It sounds minor, but here is where it becomes a real problem. If you are shopping around for a car loan, applying for apartments that require credit checks, and checking out a new credit card offer all in the same month, you could be getting hit with multiple hard inquiries simultaneously. Each one chips away at your score, and that damage lingers for 12 months. Now here is the part most people never realize. Those 5 factors interact with each other. They do not live in isolated boxes. You open a new credit card to get more available credit and lower your utilization. Good instinct, but the new card reduces the average age of your accounts and adds a hard inquiry. So one smart move triggers 2 small penalties at the same time. Net result? Your score might actually drop slightly before it recovers. The system is not designed to be intuitive. It is designed to generate data for lenders. And understanding that distinction changes how you play the game. So now you understand the 5 factors. Now let us talk about the things that can drop your score, even when you have literally done nothing. This is the part that makes people feel like the system is rigged, and honestly, in some ways it is. The first one is a credit limit reduction. Sometimes credit card companies quietly lower your credit limit. They do not always send you an obvious warning. They might send a letter you glossed over, or they might cite inactivity, or a periodic review of your account. Whatever the reason, your limit drops. And here is the consequence. If your limit drops from $5,000 to $3,500 and your balance stays exactly the same, your utilization ratio just jumped. You did not spend any more money. You did not miss any payments. But your score drops because the ratio changed. This is a system event, not a behavior event, and it can cost you points without any action on your part. The second passive score killer is a closed account. Accounts get closed for all kinds of reasons. The bank might close an inactive card. You might close it yourself, not knowing the consequences. And when that account closes, 2 things happen at once. You lose that credit limit from your total available credit, so utilization goes up. And if it was an older account, your average credit age drops. Double hit. Single event. The third one is harder to anticipate. Your score can actually drop when a credit bureau gets updated information about you, even if that information is technically accurate. A lender updating an old record, a collection being re-reported, a balance adjustment across different bureaus. Sometimes the credit file is just messy, and a data change shakes up the formula even when nothing in your behavior has changed. And here is something almost nobody knows. Your credit score is not one score. It is dozens. FICO alone has over 50 scoring models. Different lenders use different versions. The score you see on Credit Karma is not the same score your mortgage lender pulls. The score on your bank app is not the same score your auto lender sees. You have been checking a number that might not even be the relevant number for the thing you are trying to do. That is not designed to help you. That is designed to serve lenders. But knowing it exists means you can stop chasing one number and start managing the underlying behaviors that make all the versions of your scores stronger. All right, let us get practical. Here is what you can actually do about all of this. Step 1. Understand your statement closing date. Log into every credit card account you have right now and find out when your statement closes each month. That is the date your balance gets reported to the bureaus. That date is when the photograph is taken. Your goal is to make sure your balance is as low as possible on that date. You do not have to pay the full balance before the closing date every time, though that is ideal. You just need to bring the balance down before the snapshot is taken. If your closing date is the 15th and your card is at 60% utilization from a big purchase, try to pay a significant chunk before the 15th. Then pay the rest when the actual due date comes. This one habit alone can meaningfully improve your score within one billing cycle. Step 2. Keep your overall utilization below 10% across all cards, not 30%. Not the common advice of 30%. 10%. Research consistently shows that people with the highest scores, 750 and above, are typically keeping their utilization under 10%. The 30% rule is a floor, not a target. Treat 10% as your ceiling. Step 3. Never close your oldest credit card, even if you never use it. Even if it has no rewards. Even if you find it annoying. Keep it open. Use it once every few months for a small purchase. Pay it off immediately and let it sit there aging. That account is doing work for your score simply by existing. Step 4. Stop applying for new credit right before a big financial move. If you're planning to apply for a car loan, a mortgage, or a lease on an apartment in the next 6 months, go on a credit application freeze right now. Every hard inquiry you can avoid before that application goes in is a few extra points on your score at the exact moment it matters most. Step 5. Check your credit report, not just your score, at least once a year. Go to annualcreditreport.com. This is the only federally authorized free credit report site. Pull all 3 bureaus, Experian, Equifax, and TransUnion. Look for errors. Look for accounts you did not open. Look for balances that do not match. Errors on credit reports are more common than most people realize, and disputing them is free. Step 6. Like if you want to raise your available credit without opening a new card, and therefore without a hard inquiry, call your existing credit card companies and ask for a credit limit increase. Some lenders will do this with only a soft inquiry, which does not affect your score at all. Higher limit, same balance, lower utilization. Score goes up without any new account. Now this is important. Let me give you a few advanced things that most credit content completely skips over. Authorized user strategy. If you have a family member or a close friend who has a long-standing credit card with a low balance and a high limit, ask them to add you as an authorized user. You do not even need to use the card. The account will appear on your credit report, and its history and available credit both benefit your profile. This is one of the fastest ways to improve a thin credit file or recover from a hit. The hardest thing to do during a score drop is the most important thing to do. Keep making your payments on time and keep your utilization low. That is it. That is the whole game. Because your score has a memory, but it also has a short memory. Hard inquiries fall off after 12 months. Late payments lose their impact significantly after 2 years. Credit card balances are re-reported every month. The score is always recalculating. And the recalculation always rewards consistent behavior over time. Here is where people mess up badly. They see the score drop and they panic. They start closing accounts to simplify things. They stop using credit altogether because they think avoidance equals safety. Both of those responses make things worse. Closing accounts raises utilization and hurts history. Not using credit means the bureaus have nothing new to report, and a stagnant file can sometimes hurt you when a lender is trying to assess your current behavior. The credit scoring system rewards active, responsible use of credit. Not avoidance, not perfection, active and responsible. And one more thing that almost nobody talks about. You are allowed to dispute anything on your credit report that is inaccurate, incomplete, or unverifiable. By law. Under the Fair Credit Reporting Act. The Bureau has 30 days to investigate and respond. If they cannot verify the information, it must be removed. That is federal law, not a loophole. People pay credit repair companies hundreds of dollars to do this exact thing on their behalf. You can do it yourself for free. Let me bring this home. Your credit score is not a judgment of your character. It is an output of a formula that rewards specific behaviors, specific timing, and a specific understanding of how the system takes its monthly snapshot. You have been taught to think about credit in terms of responsibility. Pay your bills. Be a good person with money. That is true and important. But it is not the whole game. The people who keep their scores high through good times and hard times are not more responsible than everyone else. They are more strategic. They understand that the photo is taken once a month, and they make sure the photo looks good when it is taken. To recap quickly, your credit score is controlled by 5 factors: payment history, credit utilization, length of history, credit mix, and new credit. The one most people ignore, utilization, accounts for 30% of the score and changes every single month based on one specific date. Closing old accounts, reducing credit limits, and multiple hard inquiries can all drop your score with no change in your behavior. The fix is strategic, not dramatic. Know your statement closing dates. Keep utilization under 10%. Never close your oldest account. Pause applications before big financial moments. Pull your full credit report annually and dispute errors. Here is the experiment I want you to try this week. Pull up one of your credit cards right now. Find the statement closing date. Then check what your current balance is on that card. Calculate the utilization. If it is over 10%, make a payment before that closing date, even if the due date has not arrived yet. Just try it once, then check your score the following month and see what happened. I would genuinely love to hear what you find. Drop a comment below and tell me your result. Tell me what your utilization was before, what you paid down, and how many points moved. Because when people see this work in real time, it changes how they think about the whole system.